Hello, namaste, and good evening, everyone. Welcome to the September edition of our Equity Market Insight webinar. I am Sonal Mittal, Product Specialist at UTI, and I'll be your host for this webinar. August 2025 market headlines were dominated by discussions around tariffs, and month beginning September started GST 2.0. But that's the very nature of markets. There will be always be some news and there will always be noise. What truly matters is how we filter that noise and stay focused on our long-term investment goals. To help us make sense of these developments and the way forward, we are delighted to have with us Mr. Vetri Subramaniam, our MD and CEO designate, who will share his perspectives on the markets. Following that, Mr. Vishal Chopra, Fund Manager, will take us through the strategy for UTI Midcap Fund. As always, we encourage you to share your questions anytime using the link provided, and we'll be happy to take them up in the session. With that, let me hand it over to Vetri.
Good evening, Sonal. And yes, thank you for that very apt points that you made in your introduction. There is always something happening. And the entire purpose of doing this, monthly webinar is to be able to reach as many people as possible to provide our views on how we look at some of those issues. But as you would have already guessed through many of our conversations, we don't always react to all of this. Of course, if the facts change, we will have to change our opinions, as the famous saying goes. But more often than not, as Sonal pointed out, it tends to be more noise rather than something which destabilizes portfolios. And our attempt in each of these monthly webinars is to cut through all that noise and give you an insight into what truly matters. So without any further ado, we'll jump straight in to what I think is now coming to the forefront. Now we can discuss the various reasons why this has happened. Is there a slowdown because of the tariff uncertainty? Is there a slowdown because rates have been held up at a high level to tackle inflation for too long? Is the labor market weakening because of the early impact of artificial intelligence? Safe to say, nobody really knows the correct answer, but all of these reasons and many others may have contributed to what is now evident in terms of a slowdown. So if you look at the chart on the left-hand side, it shows you the composite PMI, further broken down into the manufacturing PMI and the services PMI. Interestingly, it is the services PMI which seems to have turned down rather than the manufacturing PMI, which is what you would have looked for a drop in case you were looking for tariff-related uncertainty. So very early days. And I must also say that in my 30 years of experience looking at the PMI, it's a very high frequency number. It comes monthly basis. It is a survey number rather than looking at hard data in terms of, let's say, movement of goods, trade of goods, credit growth, and therefore it tends to have a significant amount of impact based on how people are feeling about the environment rather than actual volume of trade in goods and services. Within this PMI, if you look at the right-hand side, the biggest drop is coming from the US, whereas in areas like Japan and also in terms of China, there actually seems to be a little bit of an uptick in PMI. The other thing to keep in terms of mind in terms of the PMI is that any reading above 50 is a positive reading. It indicates expansionary mode. Any reading below 50 is treated as a non-expansionary, which means it is suggesting a contractionary outcome. So while the lines can move all around the place, fair to say that anything about 50 is consistent with expansion rather than with a slowdown. But net looking at this data, there is some reason to believe that there are very early signs of a slowdown. More on this is visible on the next slide. And this is a more interesting slide because this points particularly to the US jobs market. And of course, you can also see the Fed funds rate on the left-hand side, which is the black line. But more interesting is the number for the US job openings. Some of you who have been listening to our market insights for a very long time would remember a point in 2021 and early 22 where this index in terms of US job openings compared to the number of Americans looking for a job, the ratio was running at 2:1, which means for every American who wanted a job, two jobs were available. Now, they may or may not have wanted a particular job, but the number of job openings which people had posted were 2x the number of people who were looking for jobs. As you can see, the number of job openings has been declining consistently now from 2022. And I think the most recent data suggests that the number of openings for the first time has dropped below the number of people looking for a job. Having said that, it's still a healthy number, but a number which was 2:1 has now finally dropped back to less than 1 in terms of a ratio. Now, that would suggest that the job market is also showing signs of cooling, and that might suggest that we are once again looking at rate cuts. We know that in the US in particular, rate cuts have become a very political issue, but the Federal Reserve Chair Jerome Powell spoke at the Jackson Hole conference last month, and he seems to have set up some headroom for a rate cut. And given the fact that US jobs data has been looking quite weak over the last two readings, there is every reason to believe that some rate cuts are ahead in the US economy for sure, but that will obviously create some headroom in other markets as well. Japan being an outlier, because remember, Japan is coming off a very low base, so it's very hard to determine if Japan, remember that's the pink line right at the bottom on the right hand side, so their rates are so low that they may not be able to really cut rates, but some of the other countries could have headroom. Moving on to the next slide. Here what we are talking about is a pivot to India. As you know, the results for the June quarter were, finally available in the middle of August, and actually some companies even slightly later than that. So we finally have the numbers for all companies in terms of their revenue growth and also in terms of their profit growth. Now, I'll give you the headline numbers. For the Nifty 500, revenue growth was in the region of about 6% year on year. Profit growth cumulatively was also in the region of about 6%. But the number that we are showing you here is how many companies within the Nifty 500 are still reporting more than 10% year-on-year growth in terms of revenue and also in terms of profitability. The blue line being revenue and the orange line being profit growth. And what you can see over here is that this number has now dropped below 50% in terms of the companies reporting more than 10% year-on-year growth in terms of profits and in terms of revenues. And keep in mind the baseline number, that is for all the companies put together, the number is only 6%, which means the 52-53% which is not captured in this chart is growing at a much lower number. It's effectively closer to zero, and that's why the average, if you look at it, will come closer to that 6% number. I should also point out that if you break down the Nifty 500 into large cap, mid cap, and small cap, we find that roughly the same number of companies, which is about 42 to 45% of companies across large caps, mid caps, and small caps, is growing about 10% year on year. So to the argument that small caps are doing better compared to large caps, it's not held out by the granular data, because large, mid, and small, in all three cases, it's about 42 to 46% of the companies which are managing to grow greater than 10%, and that's not a statistically significant number in terms of the range of outcomes. If you move on to the next slide, this shows you the other big talking point that Sonal mentioned, which is what has happened in terms of the GST rate cut. Of course, we have now cut the bands of rate cut of GST quite significantly. Effectively, it will have two operational bands. Of course, there is also a zero, but essentially the operative bands are 5 and 18. And then, of course, you have the stuff which is sin goods, which will remain at 40%. But essentially, weighted average GST rates, if you you look at this is based on a estimate from Access Research, and you can see that in May 17 we were at about 14% weighted average effective GST rate, and that number with the recent change for next year will be looking more like 10%. Now, when you compare this to other companies on the right hand side, it does appear that now we are increasingly starting to come in line with what is there in many other countries across the world, and in fact far more competitive than it is in certain other parts of Asia. But keep in mind that in India's case, a large part of taxes which are earned from things like fuel, the entire energy complex, so whether it is fuel, natural gas, coal, energy costs. Remember, there are also costs related to duties on things like land and asset transfer. None of that comes under GST purview. So we do have a rate which is lower, but there's also cascading of taxes which it happens because certain elements of costs and tax associated with that is not getting a set off benefit because it is not under VAT. But without doubt, I think this is a very positive step. And the larger way to understand this is that it amounts to a positive fiscal impulse. The government has said that the net fiscal impulse is only about 48,000 crores, which when you think about it is a very small number because the economy is almost $4 trillion, which would amount to, let's say, somewhere between 3.6 trillion rupees and 3.8 trillion rupees. So compared to that 360 lakh crore to 380 lakh crore, 48,000 crores is a very small number. But I think when you take into account the potential benefits which will also come from the cess going away next year, maybe it will be closer to 1 lakh crore, but we'll have to wait and see. We'll get a better idea of that number once we go past December. For this year, it's 48,000 crores, and that is a good number to have in terms of a fiscal impulse. And the context in which I look at this fiscal impulse is look at the sequence of events during 2025 calendar. RBI has cut rates by 100 basis points. Government gave almost a 1 lakh crore benefit by putting 1 lakh crore into the hands of people by cutting income tax rate in the budget in February. Now there's another 48,000 crores which will flow to consumers because the products they buy will have lower taxes. And this 48,000 crores they could once again use to purchase goods and services that they would want to, or they could save that money, or they could use it to spend it on discretionary items, on other items, and all of these three uses of money puts the money to good use. So there is a positive fiscal impulse of this, and the government is building on actions that it has taken year to date. Quickly moving on to the next slide. Which we'll now talk a little bit about equity markets and valuation. I'll just focus on the 1 year outcome. As you can see there on a 1 year basis, the Nifty 50 is actually the best performing index with a 3% drop. And then the small cap is down about 10%. The mid cap is down about 6%. The best performing sectors, Nifty Financial Services and banks, nothing great in terms of their absolute performance at this point, but significantly starting to outperform what the benchmark is doing. And that, is a view that we've held for a long period of time, that this is where we have the maximum valuation comfort in the marketplace. Moving on to the next set of slides. I think India just stands out here on a 1 year basis, one of the few markets which is doing poorly. China at the top, but also look at Europe. Many of those markets, whether it is Germany, UK, we don't have it here, but if you look at markets like Poland, you look at markets like Greece, look at France, all those markets, and France, despite political turmoil, all of them have done reasonably well. Regular listeners will know that I always say the two costly markets in the world, one is US, one is India. This time around, India seems to have performed poorly year to date and on a 1 year basis. US, thanks to the Mag 7 and the artificial intelligence spending boom, underperforming the rest of the world, but still at least in positive territory for the year. Moving on. What is the expectation in terms of earnings growth for 26 and 27? The earnings growth expectation for 26 is about 9%, and the earnings growth expectation for 27 is about 17%. One point I want to make, the GDP data came out for June 2025 quarter. Nominal GDP growth was about 8.8%. Now, when nominal GDP is growing at 8.8%, because that's the income of all of the Indian economy as a whole put together, it's very hard for corporate revenue to grow significantly above that number, and difficult for margins to grow significantly faster unless you have margin expansion. In that context, I think the 17% growth number for March 27 is, to my mind, a very high bar. The 9% for 26, as I said, first quarter was about 6%, presuming there's some benefits from GST which filter into corporate earnings. But remember, that will be limited because the consumer staples, consumer discretionary sectors as a percentage of market are only about 15-16% of total market. Big chunks of the market are driven more by global economy. Financials is a big component. It could see some benefit from the GST cut, but will not be so significant. So GST rate cut doesn't translate into a significant bump up for earnings. Moving on to the next slide, valuations. Nifty trailing 50 PE very much in the comfort zone. You can see it's in the white zone. We'll talk more about this later. Forward PE still in the slightly expensive zone. On the next slide, we have the Nifty price to book. Once again, very comfortably in the fair value zone, above the long-term average, which is the yellow line in the middle on the left, but it is in the fair value zone. Nifty 50 return on equity on the right-hand side, after going as high as 16%, in line with the slowdown in earnings growth, you are seeing a little bit of a downtick in terms of return on equity. What about the mid caps and small caps on the next slide? No change here. Both these indices remain in fairly expensive territory. Mid caps as a group had the best performance year on year in terms of earnings in the June quarter. But I think some of this was also because of some highly cyclical businesses. Small caps, on the other hand, the profit growth for the quarter was very much in line in aggregate with the Nifty 50. But again, both these indices from a valuation perspective still remain expensive. Jumping through to our Nifty 50 yield versus GSEC, we saw a sharp move in this index from the lows till late in 24. After that, it's been sort of moving more sideways. We are still in the zone where fixed income is favorable, but net, it's not at the extreme end of fixed income being favorable as it was little more than a year ago. Moving through to the composite valuation index indicator. Now, I should just point out that our equity valuation indicator looks at multiple factors. It looks at price to earnings, it looks at the dividend yield, it looks at price to book, and it finally looks at yield gap, which is the previous chart I showed you, which is a comparison of the 10-year bond yield vis-a-vis the forward PE of the Nifty 50. Interestingly, and remember, this index only looks at large cap valuations. Remember, price to book of the Nifty in the fair value zone, price to earnings on a trailing basis in fair value zone, dividend yield also now sort of in the traditional zone where we would expect to see it. Net as a result of that, the index has actually dropped further into the increased equity allocation zone. Last month, I think this was still holding in the yellow zone, which is the fair value for equity investing. So the indicator certainly pointing towards slightly more attractive valuation for equities. But point to note is that because it is based on Nifty 50, it points more to large cap rather than to mid and small cap, which I talked about separately. How do you use this valuation index? The implications of this index can be seen on this current slide. For example, currently the indicator is in the increased equity allocation zone. When the market is in the increased equity allocation zone, the average 1-year forward return is 14%. The best is 52%. The worst 1-year return is minus 21%. the percentage probability of a negative return comes down to 6%, and 57% of the time you get a return which is better than 12%. So everything in the equity markets has to be understood based on probability, not on certainty. And when you have an average outcome of 14% and 57 probability that your return will be better than 12%, that's what you have sort of improved the odds in your favor. And that's why, that's the way to interpret rather the data for the index that you saw on the previous slide. Moving on to my final slide, which is a summary. Good news last month was that India's sovereign rating got upgraded. And I think this is a function of the sound macroeconomic policies that we have practiced. And it is those same sound macroeconomic policies that allowed the government to cut the income tax rate in February. It is allowing the government to cut the GST at this point of time without backing away from its fiscal deficit target, without backing away from the fact that it wants to bring down debt to GDP by 2030. That is the stated target. So in reflection of the sound economic policies that we followed, India has actually ended up with an upgrade in its credit rating from S&P. US has implemented the 50% tariff on India from the end of August 2025. Still a lot of mixed signals. First time in my life that I'm seeing foreign policy being sort of discussed in real time on the X platform and on the Truth Social platform. Previously, we thought diplomacy is only something which happens behind closed doors when leaders meet and then they come out and have a press conference. But now it happens in real time. Let's see. I do think that eventually these 50% tariffs are not sustainable. The challenge for India is really to see that eventually when we are able to reach some sort of a settlement with the US, will the tariff rate be closer to 15%, which is the rate which countries like Japan and US and Europe seem to have negotiated with US, or will it be closer to the 24-26% rates which some other countries have been hit with? GST rate cuts we already talked about. Discretionary stocks have outperformed post the announcement. I know many people were discussing on the day the GST rate cut happened that some of the sectors didn't perform. But the way to think about this is that the Prime Minister telegraphed the cut on August 15th. So if you look at discretionary stocks from August 14th to today, whether they are automobile stocks, whether they are retailing stocks, all of these consumer discretionary stocks have done quite well over this period, along with some staple stocks. So in a way, the market has responded to those announcements, but you can't see it when you look at the aggregate. The fiscal impact, as I said earlier, is very, very limited on the government. That again speaks to prudent economic management. GSEC yields have gone up on the 10-year curve by about 20 basis points. Remember, we've been saying this for a while that, the best part of the roll down of yields is now behind us. Yes, the 20 basis points jump up may be a little bit of a surprise, but I think when you look at what's happening across the world, where people have not necessarily managed their fisc as a disciplined manner as we have, then in a sense, our jump in bond yields is just similar to what we are seeing elsewhere around the world. There is some possibility of another rate cut, but to my mind, more than the rate cut, what is now important is a turn up in credit growth supported by easy interbank liquidity. I mentioned earlier the earnings growth estimate, and I mentioned the fact that the market is now in the increased equity allocation zone. Having said that, we think the best way to invest in the current environment remains in hybrid funds, because the hybrid funds are not 100% equity, so they take care of some of the risks and valuation challenges in the current market environment. Simultaneously, they capture the attractive carry which is available in fixed income markets. The last 5 years have been about a very cheap market getting re-rated. So value stocks got the benefit of a improvement in earnings combined with an increase in valuations. Our sense is that today the gap in valuations between quality and value is now far more limited. So outcomes are more likely to be driven by earnings growth rather than by valuation changes. And that is why we think there is now some degree of a trend reversal in favor of quality growth over value. Our preference remains for strategies which have a large cap bias. Please note, I'm not saying only large cap funds, but we just think when you look at funds in terms of categories, we prefer strategies which would have a 50-75% exposure in large caps as compared to investing in pure mid cap category funds or pure small cap category funds. And that's coming essentially from the fact that the valuations are no longer giving you that margin of safety, and the outcomes in terms of earnings growth we think are quite similar across these market cap buckets. So I'll halt over here and hand over to Vishal, and he's going to be talking to you about the strategies that he manages. He's of course been with UTI now for almost coming up to 15 years very shortly. Started his life as an analyst. He's covered multiple sectors at UTI, including a long stint covering the consumer related sectors, and he's very recently also taken charge of the UTI Mid Cap Fund, and this is a fund which of course invests in companies which can go on to sort of dominate and become tomorrow's leaders. So over to you, Vishal.
Thanks, Vetri. So I think a lot of the members of the audience might be wondering that why are we discussing mid-cap fund today when clearly we are also stating that mid-cap valuations are on the higher side. So, I mean, I just wanted to draw some attention to how the historical performance has been for the mid-cap as a category, say compared to large caps and small caps. And we have seen historically, if you look at the left-hand side on a CAGR basis, mid-caps giving one of the best performance at almost 16% CAGR. Or even if you look on the right-hand side, where we have the average rolling returns and volatility, you will see that mid-cap as a strategy has given one of the best returns, in fact, better returns than even small cap across most time periods. In fact, on a risk-adjusted basis, I think that will be one of the best performing categories. So what we are trying to say here is that although the current valuations of mid caps obviously are on the expensive side, but if you look at longer term track record, mid caps do generate good amount of alpha. So given the current valuations, we are suggesting to avoid putting any lump sum investments in mid cap category. But I think from an asset allocation point of view, the category remains very relevant. And obviously, if you have a SIP going on, that you can continue, and whatever asset allocation you want to do basis the recent outperformance, that you can go on. But as a category, it's a category which generates alpha. So it is very important from a asset allocation point of view. That was the point of this slide. I just wanted to tie in with what we already discussed on the mid cap valuation side. Now coming to the investment style of the UTI Mid Cap Fund. So what we do in this fund is that we try to manage this with a blend of growth, quality, and value style. So we have a certain part of the portfolio focused on quality growth stocks, and certain part of the portfolio focused on value styles. And how do we achieve that is to construct a portfolio by trying to focus on three types of different investment opportunities. And if you look at the middle part of the slide, the core part of the portfolio is in the sustainable businesses portfolio. These are the typical stocks or companies which we think have a good or a sustainable runway for growth. They have healthy return ratios and cash flow generation. These companies either have good pricing power, they're able to gain market share, they have good network effects, or they have cost advantages. And I would say this is the part of the portfolio which you will find in any quality growth portfolio of any other fund manager. The second bucket is the cyclical opportunities. These are typically cyclical businesses in cyclical industries where we think that if the current valuations or current profitability levels are at bottom, and if they could do mean reversion on profitability along with valuation, giving good upside to those stocks in the portfolio. So these are the typical cyclical companies, and this forms more of the value bucket of the portfolio. And lastly is the transformation or the turnaround opportunities. These are businesses which we think are good quality businesses, generally doing well, but for various internal or external reasons, the company is going through a rough patch. It could be because of change in management, it could be because of change in regulatory environment, change in competitive intensity in the sector. And if we think that going ahead, because of because of certain things happening with the company or in the sector, things could improve or things could turn around. And if valuations are in favor, we try to take bet on those kind of companies where we get the benefit of both the turnaround in earnings as well as valuation re-rating. So this is the transformation or turnaround bucket of the portfolio. And all three put together helps us create a blend of growth and value and help us manage a blend style of portfolio. So just to make things more clear, what I'll do is I'll just try to give one example each of the three buckets. And these are all the three stocks which we already have in our portfolio in the UTI Mid Cap Fund. So on the sustainable business side, I'm giving example of a Persistent Systems. It is a mid-tier IT sector company. And if you look at their historical performance, they have been a outperformer in the sector. In last 5 years, they have given more than 20% CAGR in revenue in US dollar terms. The EPS has grown at more than 30% CAGR. And if you look on the right-hand side, they have very stable and healthy ROICs. And the stock has obviously done phenomenally well. I think the 5-year return will be more than 80% CAGR. Obviously, it also gets impacted a little bit because of the COVID bottom, but still the stock has been one of the best outperformers in the sector. Second example of which is of cyclical opportunity, which is part of portfolio, is GE Vernova. So this is a company which plays in the power transmission and distribution equipment business. And as we know, the power spends, the distribution and transmission spends are generally more cyclical in nature. They go through their own cycles. There's a phase of very high capex in that sector, and then there's a lull, and then again there's a phase of strong capex. So if you remember, during the period of 2007, 8, 9, you had good spends, power sector spends. Then there was a lull for almost 10 odd years. And post-COVID, we have again seen increased power spends both on the generation side and more importantly on the transmission and distribution side as well. And if you, in that phase when growth was muted, the company's margins were continuously going down. They bottomed out somewhere in FY22. And if you look on the left-hand side chart, the yellow line, the margins which were almost in the negative territory have significantly improved to almost 20%. That just shows the inherent cyclicality in the business. And that kind of cyclicality gives us opportunity to buy the stock and obviously ride the upside in the cyclically in the earnings. And if you look on the right-hand side, the same is visible in the order inflows as well. The order inflows were in a very tight range for almost 10 odd years. And over the last 2 years, where we have seen significant improvement in order book. And I think that is expected to continue for a few more years as that we are still in this cycle of cyclical upside in the sector. And again, the yellow line shows you the share price. The share price, which was very stable for a long period of time, has given phenomenal returns over the last 2-3 years. Last example I would like to give is of a turnaround or a transformation opportunity, and that is of Suzlon Energy. It's one of the largest wind equipment manufacturers, and the company had a very terrible time in terms of both leverage and their share price performance for almost 10 odd years post the global financial crisis. And if you look on the left-hand side, the company had a very high debt. Over a period of time, the company restructured the debt, they raised some equity, and obviously the leverage came down to very comfortable levels. Today, they are a net cash company. And at the same time, if you look on the yellow bar on the left-hand side, the EBITDA also started improving. And this also coincided with the pickup in the wind energy installations in the country. The order book started to improve. So if you look on the right-hand side, Suzlon's order book again, which was flattish for a long period of time, started seeing good growth over last 2-3 years. And the combination of uh, declining leverage, improving EBITDA, and obviously improving order book, giving good visibility, the stock has obviously got re-rated and has done very well. This is again an example of a turnaround opportunity which was highly leveraged and the balance sheet improved, and the company has seen good prospects and the stock price has obviously done very well. I hope with these examples I have been able to convey what our investment style is. How do we try to find out opportunities in different buckets and try to create a blend opportunity. These are just some of the portfolio statistics. We have 68% of the portfolio in mid cap, the balance in large cap and small cap. We try to identify opportunities in the small cap space as well, which we think can going ahead transition to the mid cap space as they continue to do well. If I just wanted to highlight on one more metric in this table is the price to book. The price to book multiple of the portfolio is very close to benchmark. It is just 5% above benchmark. Having a blend style means that we try to have the price to book, price to earnings of the portfolio close to benchmark. So generally, if you look at the price to book of this portfolio will be in the range of 10% plus and minus compared to the benchmark. And because our overall investment process, investment framework at UTI focuses on operating cash flow, return on capital employed. So if you look at both R1 and C1 metrics of the portfolio, they are above the more than what it is in the benchmark. This is the same thing which I spoke about. Again, I'll just highlight the price to book multiple chart, which is in the middle in the bottom. And if you look at the blue line, which is the fund price to book, and the yellow line, which is the benchmark price to book, you will see that they are very close to each other. Again, reflecting the blend style of the portfolio management for this portfolio. Generally, if a portfolio manager is managing the portfolio with a quality style, the blue line will be significantly above the yellow line. And if it is managed with a value style, the blue line will be significantly below the yellow line. Since we are managing this with a blend of growth and value, the valuation of the fund is almost quite close to the benchmark. The other key differentiator, I would say, of the UTI mid-cap strategy is the focus on large cap isotopes. I'll just take some time to explain what do we mean by that. Generally, isotopes are something which basically there are two molecules with similar chemical properties, but they are different. So in this, what do we mean is that there are certain companies which are leading companies in their sector, but just because the sector itself is not large or small in size, the largest company in that sector is actually a mid cap and not a large cap. But having said that, even though they are mid caps, they actually have all the characteristics of large caps, like they are market leaders in their segment, they have good cash flows, they have pricing power, or they have good return on capital employed and good cash flow generation. So these are the top 15 large cap isotope holdings in the portfolio. And I'll not spend time to explain everything. I mean, it's a list which can be well understood, but just to give you example of one or two here. So if you look at the first name in this list, which is Polycab India, Polycab is the market leader in the cables and wires segment in India. But because the cable and wires sector as such is a relatively small sector, the largest company in that sector is a mid cap, but I think now very close to becoming a large cap company. And we have invested in this company since long time, and we have seen very strong improvement in their cash flow generation, their growth, the return on capital employed, reflecting in the share price performance. The second example, if you look at the second name in the list, is Phoenix Mills. Again, this is one of the largest mall developer in the country, but because malls are relatively underpenetrated in the country, the overall sector size is small. Even the largest mall developer is a mid cap, but they have seen phenomenal growth in last 10 years in their mall space, in their revenue, in their EBITDA, and in their market cap. And we believe as number of malls and penetration of retail space keeps on increasing in the country, I think Phoenix Mills eventually can become a large cap company as well, giving a good performance. So this is our current portfolio. On the left-hand side, you see the top 15 holdings by NAV. So the top 15 companies, we have almost 29% of the portfolio in top 15 companies. And on the left-hand side, you see the unique stocks. These are the stocks which are currently not part of the benchmark. So 32% of the portfolio is in companies which are unique or which are not part of the benchmark. And this is some of the top overweights, underweights. And on the right hand side, you see the active position in the various sectors. In this, I'll just want to highlight few is that if you look at the fund is clearly overweight on the consumer discretionary space. If you look at automobile, consumer durables, consumer services, I think there is a under penetration in most of these sectors. And I think most of these sectors will be beneficiaries of the recent GST rate cuts. So the fund is underweight on all these sectors. The fund is underweight if you look at the FMCG space, because we think although they will also benefit from GST, but I think from a structural point of view, we are more bullish on consumer discretionary over consumer staples, given that consumer staples already have a fairly high level of penetration. We remain positive on financials, so actually we are not underweight on banks and lending space. The underweight in financial services is largely because we are underweight on the capital market stocks, which have a large weight in the mid cap index. As we believe, I think cyclically they are already at both in terms of earnings and valuations, they are already very high. Just to end, I think I just wanted to show, I mean, what the longer term returns of the portfolio, and obviously, being a mid cap fund, I think the one of the message we want to give is that you have to invest in this strategy with a more longer term horizon. So if you look on the top chart, top part of the chart, you will see that if you look at 3-year, 5-year, or 10-year data, in most time periods, the median return of the strategy has been around 17 to 18%. But what is equally more important is the bottom part of the chart. And if you look at it, the instances of negative return, as you increase your time horizon, the instances of probability of or the instances of negative return significantly goes down. So if you invest in a mid cap strategy for just 1 year time horizon, there's a decent probability, almost a 22% probability that you'll end up making negative returns, and which has happened in last 1 year. But if you increase your time horizon to 3 years, it drops to 6%. But I think the real time horizon we need to have in mid cap strategies at least 5 years, because 5 years and plus you see there's negligible or almost 0% probability of negative returns. And in fact, there's almost a 80 to 100% probability of returns over 8%. So I think mid cap strategy, it's very important that we come with a more longer term horizon. I think that's it from my side. Over to Sonal again. Thanks. Sonal, you are on mute.
Thanks. Yeah, thank you, Vetri and Vishal, for those valuable insights. The floor is now open for Q&A, and let's take up some of the questions we have received from our audience. Vetri, my first question is to you. For the first time in 18 years, India's sovereign rating has been upgraded, even as we saw US having a downgrade in the month of May by Moody's. You mentioned that prudent policies helped India with the rating upgrade. However, what does this divergence signal for global markets and investors' confidence?
Sure. The truth, Sonal, is that this really doesn't matter very much because in some senses, credit ratings anyway are a bit of a lagging indicator. We equity investors don't tend to pay too much attention to small changes in the credit rating, though of course a very big change in the credit rating would cause them to panic, but small changes like this really don't matter too much to equity market investors. And finally, this tends to be a reference point more for historically for the foreign banks in terms of their lending to India. But because of the development of such a deep equity market and also a reasonably large dollar bond market for Indian companies, I don't think it is very relevant. But I just want to add one more point. If you look at what S&P said about India's credit rating and why they have increased it, the simple reason for doing that was not only the prudent economic management, but the fact that India's growth rate, we can debate 6.5%, 7%, but that growth allows you to constantly work through some of your, legacy issues in terms of debt to GDP. So I think, therefore, this places us on a good wicket, but I would say this is very belated recognition of our strong credentials. I would not consider this market moving information in any way.
Thank you, Vetri. Vishal, coming to you. You mentioned, and as we are seeing, valuations in the mid and small cap segments remain stretched. Given that, why would investors consider investing in this fund at this point in cycle, and what should be their investment approach?
So I partly covered this in my presentation as well. I think you're right, and Vetri also mentioned very clearly, and we have in the data as well, is that valuations of both mid and small caps are significantly above average. So that's why we are recommending, obviously, certainly not to invest on lump sum basis, But what I also said during my presentation is that obviously if someone has an SIP going on or there's an asset allocation of any investor, I think you continue with that from an SIP point of view. But yeah, given the valuations, lump sum investment should be avoided in the mid cap strategy for now.
Sure. Coming to you, Vetri.
Just to add, Sonal, I think,
Yeah.
it can't be taken as a top-down rule. It's only a prescription. And B, keep in mind that if somebody is saying that, look, I only invest 5% of my, let's say, annual savings into mid-cap funds because the rest is going into, let's say, asset allocation funds like balanced advantage is going into large cap funds, then anyway, they have taken care of that risk. We are just saying that if you are trying to choose at this point of time risk reward equation, large cap versus mid cap versus small cap, then this is our preference or stacking order in terms of where we think the risk reward is reasonable. But there can be many reasons where somebody might say, I know that, but I've already taken care of it in my allocation and how I'm investing. So, there would be many people who would say that therefore we would like to continue. And it's reason specific, it's context specific.
Sure. Thank you, Vetri and Vishal, for those valuable inputs. Vetri, my next question is for you. With US tariffs now in play, what kind of government responses should investors look out for?
Sorry, will you just repeat that? Your voice faded at the beginning.
With US tariffs now in play, what kind of government responses should investors look out for?
I think what is increasingly evident more from behavior rather than from any strategic direction or template is that 10% is the base tariff rate, because that is going to get applied on countries, including UK, which actually UK has a trade deficit with the US, but even they will now have their goods will have to pay 10%, though there was some carve outs. I already mentioned Japan and Europe, which have negotiated a 15% tariff rate. So it looks like we are eventually settling down at a 15 to 20% tariff rate. As long as everybody is at that level, I would still presume that eventually this is nothing but a tax on the US consumer. Of course, producers will also bear some impact of the tariff, but a lot of it, and there is data already showing that a lot of it is being borne by the US consumer. If that causes the US fiscal deficit to come down, that is a problem that anyway the US needs to address. Its fiscal deficit at $1 trillion a year, at 6 to 7% of GDP, almost $2 trillion a year, is just too large. So I think it's now more a US specific problem. As long as countries are competing with each other in the range of 10 to 20% tariff, then it comes down to cost competitiveness. I don't think anybody can say, oh, my economy is at 20, some countries at 10, therefore my country and my trade is finished. No, global goods and supply will reorient themselves. Somebody may decide, hey, now I have an opportunity to supply to US. Some Indian company may say, okay, I've got a better deal with my trade agreement with Switzerland and with UK, so I will now find customers there and supply there. So I think at 10 to 20%, if everybody is at that range, the worst of the tariff impact is now behind the global economy. But yes, US consumer is picking up some part of the tab for that.
Sure. Thank you, Vetri. Vishal, coming to you. Given the scale of the fund and investable universe of 150 mid-cap stocks, how do you tap into the opportunities in this segment?
No, I mean, one of the things we need to keep in mind is that uh, as per the SEBI classification, uh, minimum of 65% has to be in mid-cap stock. So I think that 150 stocks you referred to, that is 65% of the portfolio. Obviously, we are at 68% today. So, but we do have a fair bit of flexibility for the balance, say 35% to invest in good quality small caps, which we think can potentially outperform and become mid caps. And that is a large space from the 251st stock to onwards, wherever we think there's good quality, good management quality, and they meet our internal research and the criteria, we can invest in those. And also at the same time, we do have at any point in time some, like today I think we have around close to 8% investment in large caps. We don't go and invest in large cap stocks as such, but there are a lot of times we invest in mid caps who eventually become and graduate to large caps, and we continue to hold on to those stocks because they continue to do well. So you're right, there's some bit of restriction in terms of 150 stocks. but I would say that is 65% and that is fairly manageable. And as mid caps, you are seeing more and more IPOs coming in directly in the mid cap space. So the options are increasing. The liquidity and the market cap of the mid cap stocks itself are increasing. So that itself gives more opportunities to invest in that. So I would say at our scale and our size, this is not a constraint.
Thank you, Vishal. Vetri, coming to you. There is a growing fascination for private markets among affluents, largely in pursuit of that extra kick. What would be your message to our viewers and investors seeking long-term wealth creation? Vetri, you are on mute.
Yeah, sorry. I think simplicity sits at the heart of any, long-term wealth creation and sensible wealth creation. Look, the biggest wealth creation happens when entrepreneurs, create a company and 100% of their net worth is in the company and it creates crazy amount of wealth. But let's face it, most investors who are coming here are just trying to secure their financial goals by sensible investment policies. I think plain vanilla diversified portfolios are the best way to do that. You can have some exposure to alternates, particularly if they are giving you a slightly different volatility profile. They are giving you some effective diversification. But, I'm not a great fan of trying to go completely into alternates. Also, because I think the underlying structure of the Indian economy and equity markets, we can debate valuations. When is it most comfortable? When it is not comfortable? But I think the structure of the market is set up to give you a very reasonable return where you can meet your aspirations. You can certainly meet your needs, but will it meet your greed? I don't know. But the level of risk that you take to meet your greed may not be something which is appropriate either. So I think that's a very personal call that each investor needs to take.
Right. In interest of time, I will take two more questions. Vishal, this question is for you. With GST 2.0 and recent mid-cap correction into certain pockets, where do you see, value pockets in specific sectors?
No, I think I mean, there are two different questions. One is the GST beneficiaries and one is the value. I think the second is can be dependent or independent of the first one. But let me just focus on the GST thing because I think that is where the I mean, what is the recent things have happened, and I think which we covered also partially in the during the course of the presentation. The biggest beneficiary in due to the GST cuts is in the auto and the consumption sectors. The question to ask is that which subsectors, which companies will be able to see a far more acceleration in earnings because of this cut? And there, obviously, there are two things which matter. One is the sectors where there's a good price elasticity of demand. So there are sectors where, because of the price cut, because of GST, will there be enough volume uptick? And secondly, sectors where there's a good enough operating leverage that because of that higher volumes, your margins can also expand, giving further kicker to your earnings. So if you look at those parameters, it is clear that companies are more in the consumer discretionary side, which be it autos or be it durables. I think those are the sectors where you have higher price elasticity of demand, where obviously because of a rate cut in a four-wheeler or a two-wheeler or a air conditioner or any other consumer durable, the price elasticity higher. So if there's a price cut, consumers will tend to buy more. And on top of that, because of that higher volume growth, the companies will also be able to improve their margins, which could lead to better earnings growth. At the same time, if I compare the same thing in FMCG, I think the FMCG sector as a whole has much lower price elasticity. They have much lower operating leverage. Obviously, they will also benefit, but on a relative basis, I would say the whole consumer durables auto space will benefit more compared to FMCG. And as I discussed, our portfolio is already positioned that way. So I don't think we need to make too many incremental changes to benefit from this improvement in earnings because of the GST rate.
Sure. Thank you, Vishal. Vetri, my last question is for you. India has banned all forms of real money games, citing social and financial risk, even as consumer spending touched nearly rupees 10,000 crores in July 2025. So, what are your views here, and how significant could its impact be on jobs, revenues, and digital economy?
Sure. I think some of these decisions, when they are taken, there will always be some beneficiaries and there will be somebody who gets hurt by the decision. I think the country has taken a decision saying that, and remember, this 10,000 crore number is based on what the chief economic advisor referred to as the money on average every month, which was being transferred through the UPI system. Now, in addition to that, people may have also been using other payment forms, whether it is normal bank transfers or whether it is, credit cards to participate in real money gambling. So 1,20,000 crores on an annualized basis spent by consumers is a minimum number. It could even be higher than that. That is a big number. I think rightly so, the government is concerned. And, we've seen the data in terms of how many younger people, what you would call 18 to 24 first time people entering the workforce, who were actually participating in this. High participation by women as well. I'd love to see more participation by women in many things, but seeing high participation here was actually surprising. And therefore, I think there are many reasons for the government to say, hey, we need to sort of put a break on this. Remember, the government is not saying they will do away with gaming. They have actually said things like esports, people taking part in non-money gaming, they are fine with. So if people want an outlet to play something online, that will still be available because these regulations permit that. It is real money gaming, which you might otherwise call gambling, that they are trying to put a halt on, because we do have to worry that this is something which could compromise our demographic dividend. Now, there has been, I believe, close to, maybe even $2 billion of, money from VCs and PE funds, which may have gone into this sector. Obviously, all of that will take a big hit. So yes, there is some corollary damage, but sometimes when tough decisions have to be taken, you have to see what the longer term benefits or ramifications of not acting could be vis-a-vis what the immediate cost of taking those actions can be. So, I think policymakers have taken this decision in order to, preserve the long-term benefits of the demographic dividend. We don't want people destroying their lives and money on this easy form of gambling. And without doubt, making this available on a mobile phone means that the barrier to get involved has really had gone down very significantly. Yes, some corollary damage is possible, but as far as the economy is concerned, if people were spending 1,20,000 crores here, now they'll spend it somewhere else. So the economy will move on, but there will be some capital damage to those who were, part of this industry. But when that spending moves to other industries, people will get re-employed in other, industries. So yes, painful at a micro level, but in a macro level, I think it is a prudent and welcome decision.
Thank you, Vetri. On behalf of UTI Mutual Fund, I would like to thank all our viewers for joining us and for the active participation. We hope you found today's session insightful, both in terms of equity market outlook and strategy for UTI Midcap Fund. Do share your feedback through the link provided. A special thanks to Vetri and Vishal for their valuable insights. Thank you once again for being with us. Stay informed, stay invested, and we look forward to seeing you at our next Equity Market Insight webinar. Thank you.
Thank you.
Thank you. Have a good evening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.